There's an everything bubble. Everything's in a bubble except gold stocks, right? Or gold. I mean, the things that people should be buying are the only things they're not. You have like a reverse bubble there. And we're trying to figure out ways to gamble with cryptocurrencies while the world is making all the stuff that we actually need. And while we're talking about and we're encouraging our citizens to load up on Bitcoin, the rest of the world, the Chinese, they're buying gold, right? So this is part of this huge bubble, this Bitcoin bubble, and the stock market bubble, and the housing bubble, and the bond bubble. It is much bigger than what we had in the 90s and the 2000s. And because it's bigger, it's doing more damage.
Very much what the People's Bank of China has been doing. And it's being emulated by Chinese nationals, Chinese citizens, who not only take delivery of gold and, bars out of the Shanghai Gold Exchange system, but they also run gold accounts at their banks. And with the People's Bank of China having reduced interest rates a little bit recently, the alternative attraction, which is bank deposits.
I would suggest that people have at least 5% of their net worth in physical gold. And I would suggest that they hope it goes down in price.
In today's episode, 3 renowned financial experts, Alasdair Macleod, Peter Schiff, and Rick Rule, share their insights on the future of gold, silver, and the global economy. From the risks of fiat currency to the opportunities in precious metals, they break down why owning gold and silver is more important than ever. We watched hours of footage to bring you the best clips so you don't have to. Stick around for expert commentary, actionable insights, and a deep dive into the world of wealth preservation. But first, smash that subscribe button and check our pinned comment for some massive offers on NordVPN. If you're a serious stacker, this is a perfect fit for you. For less than the cost of a Financial Times paper, you can protect your online activity from prying eyes with the most reliable VPN on the market. Trust me, the only thing you'll regret is not getting it 6 months ago. Enjoy the episode.
And all the things that are, at the center of the bubble, that's what everybody's buying. Everybody is piling in to these bubble assets, from tech stocks to cryptocurrencies, while they're ignoring the out of favor assets that will come into favor, I believe, as the air comes out of this bubble, one way or another. And I think the most likely way that it comes out is with massive inflation. I think you see a big decline in the dollar, and so you get real declines in asset prices more so than nominal, meaning it's not the Dow crashes, real estate prices crash, it's that the dollar crashes. And so asset prices are reduced more in real terms than they are in nominal terms, although we could have a little of both. And I've said that we're not going to see any relief. Long-term yields are going to keep rising until the Fed goes back to QE. I think even if we get more weak economic data, it still might not matter, because all the economic data that we got this week, and I'm going to go over that in a little bit, but all the economic news we got this week was bad news. And the bond market shrugged it off. It didn't matter. I mean, maybe if we get a big spike in unemployment or something like that, but even if that happens, which is probably going to happen at some point, I think any rise in bonds will be sold. Yields are headed much, much higher. And it's not just here. It's all around the world. In fact, it may be even more significant what's going on in Japan. Look at the 10-year Japanese government bond. I haven't talked about this in a while, but I talked about it quite a bit when the yields got up to 0.5%. And the Japanese government was kind of drawing a line in the sand, trying to defend the 50 basis point yield, because yields were lower. They went up to 50 basis points. And I was predicting that the Bank of Japan would not be successful, or the government, and yields would rise. Well, the yield now on the Japanese 10-year government bond is 1.1%. It's just getting started. So while all the experts are, still scratching their heads trying to figure out this, divergence, right? Nobody expected this to happen, least of all the Fed. Look at what's happening now to mortgage yields. We almost got down to 6% when the Fed started cutting. That first cut, we were down to like 6.1 on a 30-year fixed. Now I think we're back up to 6.85. I think by the first week of January, we'll be back with a 7 handle on the 30-year fixed rate mortgage. That is a very problematic level. It's already problematic now, but it's going to get worse, and it's not going to stop. And I think the Treasury yields aren't going to stop when we hit 5. I think we're going to break through 5 early in January, especially if you look at what's going on with the debt problem. Donald Trump, actions speak louder than words. I hate to say I told you so, but I told you so. But in the first little battle about the debt, right, they had this continuing resolution that they wanted to pass. And the initial bill, was a much more voluminous bill. And at least to his credit, Elon Musk managed to put the kibosh on that one, because he put it on X and he showed this monstrosity that they wanted to pass that nobody had a chance to read. And so they ended up passing something that was a lot smaller, but it still did a lot of damage, because it still had 110 billion of additional spending. Maybe it had somewhat less than the original bill, but it still passed. And what Donald Trump objected to, he was demanding, along with Elon Musk, he was demanding that the Congress include in that continuing resolution a 2-year suspension of the debt ceiling, so that they wouldn't have to deal with the issue, and that the sky would be the limit on the debt over the next couple of years. Now, if Trump really was serious about doing something about the debt, he would want to leave that ceiling in place. I mean, that's the only tool we have to reduce spending. Not that it's, worked that well, but I mean, that's the only thing that the Republicans have had up their sleeves is, negotiating the increase in the debt ceiling to try to exact some modicum of spending reduction. But if we've run up, over $36 trillion of debt with a ceiling, right, we're going to run up a lot more without it. Donald Trump didn't want that there. In fact, Donald Trump was out there saying that he wants to get rid of the debt ceiling entirely so that it doesn't even exist anymore. Again, that's all we got.
In the continuation of the episode, Alasdair Macleod dives deep into the macroeconomic situation, explaining how the BRICS nations are reshaping the global financial landscape. He explores their growing efforts to reduce reliance on the U.S. dollar, the implications for global trade, and how these shifts could impact the price of gold and silver.
Now, again, this is where market commentators get the relationship between gold and yields completely wrong. They think that if you get a higher yield, it makes gold less attractive because gold yields 0 or 1% or on a lease rate or whatever. But what they ignore is the whole purpose of gold is actually to hedge out of credit. And what we're looking at in terms of credit is fiat currencies, and particularly in this case, the dollar. So if the value of the dollar starts going down in terms of its purchasing power, then gold will appear to rise. And that's basically what we face. I think that there's a huge error, if you like, in central bank thinking that the purpose of interest rates is to manage economic outcomes. No, it is not. I mean, if you go back to the days of gold standards, it was there basically to manage your gold reserves. In other words, if the gold reserves started going out of the door, you had to raise interest rates to make your currency, which was a gold substitute, attractive to the arbitrageurs to get the gold flowing back into your reserves. That's actually the true role of interest rates, is to stabilize the currency, not to manage the economy. And of course, so all central banks are doing completely the wrong thing. This is now basically what's happened is that by using interest rates to try and manage economic outcomes, every time there's been a credit bubble, the response from central banks has been to reduce interest rates sharply, to take the pressure off malinvestments, off the zombies, if you like, off banks which may be over-leveraged for those conditions and face substantial loan problems, if you like, bad debts. Take pressure off markets. I mean, ever since Greenspan, he was talking about you've got to keep the stock market bubbling, take the pressure off the stock market. So you've had bubble after bubble after bubble, and we are now finally in the largest bubble ever known in history. This is larger than John Law. It is larger than South Sea bubble. This is the big one. It is larger than the dot-com bubble. And I remember the human psychology in the dot-com bubble was exactly the same as, you read accounts of, the Mississippi bubble and the South Sea bubble and the tulip mania and all these bubbles. I mean, it was up there with the extremes. This is twice as big. I mean, when this bursts, it is there's nothing, absolutely nothing any central bank can do about it. Because by reducing interest rates this time, they just collapse their currencies. That is really how serious this situation is. And I think that we're likely to see this develop in 2025. The only way out of it is just get the hell out of credit. And if you're going to get the hell out of credit, what do you go to? Well, the only thing is real money, which is gold, and to a lesser extent, silver.
In today's news recap, gold in holding pattern as markets await U.S. data. Gold prices slipped in thin trade on Monday as markets awaited next week's U.S. economic data and the potential impact of President-elect Donald Trump's return to office on the Federal Reserve's 2025 outlook. Spot gold was down today to $2,618.99 per ounce. Quiet day with lower liquidity across all asset classes, likely due to the holiday season. UBS analyst Giovanni Staunovo said, adding that market participants will track upcoming U.S. economic data to see if the economy is slowing, which would allow the Fed to keep cutting interest rates. Fed Chair Jerome Powell said earlier this month that U.S. central bank officials are going to be cautious about further cuts after a quarter-point rate reduction in December, in line with expectations. For insights into the health of the world's economy, traders await next week's U.S. job openings data, the employment report, the FOMC meeting minutes, and the U.S. employment report. We still see the same factors in place which supported gold in 2024, ongoing central bank purchases with a desire to diversify their reserves and ongoing U.S. rate cuts supporting investment demand. Stanovo said, gold has gained around 27% so far this year. It hit an all-time high of $2,790.15 on October 31st. Markets expect significant U.S. policy shifts in 2025, including potential tariffs, deregulation, and tax changes after Trump returns to the White House in January. Now we'll show you more clips of the latest interview, but first smash the subscribe button and check our pinned comment for some massive offers on NordVPN. If you're a serious stacker, this is a perfect fit for you. For less than $4 per month, you can protect your online activity from prying eyes with the most reliable VPN on the market. And believe me, the only thing you'll regret is that you didn't get it 6 months ago. Let's get back into the episode.
I would suggest that people have at least 5% of their net worth in physical gold. And I would suggest that they hope it goes down in price. The set of circumstances that causes your gold to go up rapidly in price, which I think we're likely to see, are invariably fairly unpleasant. But certainly if silver is cheap, gold is cheap too. Gold generally moves before silver does, although silver, when it moves, generally moves further and faster. If the question goes to holding physical commodities as opposed to holding equities around physical commodities, the most convenient to hold and store are gold, silver, and platinum and palladium. About very soon. And you know what? $3,000 isn't a number that excites me at all. I wouldn't own as much gold as I own if I thought it was going to go from $2,700 to $3,000. I own it because several times in my life, it's gone up fivefold or sixfold or sevenfold. I own it because the net on-balance sheet and off-balance sheet obligations of the U.S. government exceed $120 trillion. And those obligations, both on and off balance sheet, annually exceed the gross income of the federal government before expenditure. That's why I own gold. I don't own it because I hope it's going to go to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000. Many, many, many investors are. It seems that when investors get bitten by the gold bug, they often go whole hog. In my life, when gold has moved, the moves have been dramatic. And if you think of it as I do, as insurance, a fairly small premium goes a long way. If, as an example, you had gold at the beginning of the decade of the 70s, understanding the type of inflation that we would experience in the 1970s, when the gold price moved 30-fold, had you had 10% of your portfolio in gold, you would have enjoyed a triple over that decade on your total portfolio. If you had gone through a much more modest bull market, like the period 2000 to 2010, where the gold price went from $250 an ounce to $1,750 or $1,800, which is to say a sevenfold increase, a fairly small proportion of your net worth in gold would shield most of the rest of your portfolio from the harmful impacts of the deterioration in the purchasing power of the U.S. dollar. Many, many, many people overinsure. Many, many, many people have too much of their assets in physical precious metals or more riskily in penny stocks associated with gold and silver.
What do you think of today's show? Do you agree with the insights shared by Alasdair Macleod, Peter Schiff, and Rick Rule? Or do you have a different perspective on the future of gold and silver? We'd love to hear your thoughts. Post your honest price prediction for gold and silver for next year in the comments below. Will we see record highs, or is the market due for a correction? Join the conversation and let us know where you think the metals are headed. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.